Welcome to today's Canary Report. Markets are risk-on, but watchful as investors digest a major geopolitical breakthrough, alongside fresh hawkish whispers from Federal Reserve officials. The day opened with uncertainty regarding the Iran deal's long-term supply implications. But by midday, the VIX has collapsed and tech hardware is surging. Let's see what our canaries are telling us about where this sentiment is heading next. Speculative sentiment remains firmly in risk-on territory today, with spec leaders collectively posting gains across the board. ARKK moved up 0.87%, while SPHB gained 1.33%, signaling that active growth capital is rotating back into high beta tech positions after yesterday's consolidation. This isn't a blind chase. It's a calculated response to reduced geopolitical tail risk. Though we're watching Cathie Wood's fund dump another 26.7 M of Robinhood, despite the stock's 36% monthly surge. The greed meter suggests investors are willing to hold speculative longs for now, provided the Fed doesn't pivot aggressively in the next earnings window. Credit markets are showing surprising resilience, with yield spreads compressing and absolute prices climbing. High jumped 5.44%. HYG followed with a 0.33% gain, and HYGW held steady at 0.24%. This indicates that corporate credit is no longer viewed as a primary risk transfer target compared to equity volatility. Investors are accepting higher duration in fixed income because the default probability has dropped sharply post-deal. The pulse is stable but watchful. Any disruption to global trade flows could quickly reinflate high-yield spreads, so liquidity remains tight despite the price action. Fear has evaporated faster than most expected, with UVXY dropping 2.73%, VIXY down 1.79%, and VXX shedding 1.51%. The headline driver here is clear. The US-Iran preliminary peace deal removed immediate supply shock fears that were keeping volatility elevated into this week's open. However, the VIX itself fell a massive 11.06%, meaning the market is pricing in calm rather than just relief. That said, the headline "The VIX isn't broken" suggests algorithms may have overcorrected on vol compression earlier today. We're seeing a reversion where smart money positions volatility as an asset class again. Not just a hedge, the real economy engine is firing, led by semiconductors and hardware infrastructure. SMH surged 3.75%, outperforming almost every other sector index today, while IWM, small caps, gained 1.08% and KRE, retail, ticked up 0.36%. This hierarchy tells us that physical production confidence, specifically in chips and manufacturing, is the primary driver of today's breadth. With oil prices down slightly at $75.52, input costs for hardware manufacturers are stabilizing, allowing capital to flow into capex-heavy tech names rather than defensive staples like XLP, which slipped 0.69%. Safety assets split sharply between traditional bonds and precious metals. TLT rose 0.52% as the 10Y Treasury dipped to 4.45%, creating a flight to duration where investors prefer coupon-bearing treasuries over non-yielding gold. GLD, however, sold off 3.5%, a rare decoupling from equities, and broad bonds gained only marginally at 0.38%. This suggests the dollar's strength, currently trading up 0.72%, is weighing heavily on gold's relative appeal compared to real yields. The safety trade isn't dead, it's just being executed through interest rate-sensitive instruments, rather than commodity hedges for now. The dominant theme today is geopolitical relief, outweighing Fed uncertainty, with tech hardware acting as the primary lever for that upside. While Kevin Warsh's comments create a looming overhang about potential rate tightening, the immediate demand from supply-side stability, oil down, trade flows stabilizing, has pushed risk assets higher and volatility lower. We're seeing capital rotation into SMH-like sectors, while speculative funds like IRKK begin trimming exposure to retail names in favor of broader tech plays. That's your Canary Report for today. Stay vigilant as the market digests the full terms of the US Iran deal, but don't ignore the warning signs from active funds reducing their retail exposure. We'll see you tomorrow with more analysis on how this volatility compression impacts next week's open.